Something moved last week. $4.7 trillion, quietly, systematically, and almost nobody noticed. Pension funds, insurance giants, sovereign wealth managers, all of them pulling out of the same place at the same time. This wasn't scheduled. This wasn't announced. This was an exit. And it just started. Now, before we go any further, let me be very clear about something. $4.7 trillion is not a number you see in normal market activity. That's not portfolio rebalancing. That's not seasonal adjustment. That's not risk management. That is the largest institutional capital flight in recorded financial history. To put that in perspective, 4.7 trillion is larger than the entire economy of Germany. It's 3 times the size of Apple, Microsoft, and Google combined. It's enough money to buy every share of stock in the S&P 500 twice. And it moved. Out of bonds, out of treasuries, out of dollar-denominated assets in less than 90 days. The financial media isn't covering this. CNBC isn't running special segments. Bloomberg isn't flashing red alerts. Why? Because the entities doing the selling don't want you to know. And the entities that should be sounding the alarm are the ones caught in the middle. But the data is public. It's sitting in regulatory filings, in footnotes, in disclosures that most people will never read. And what those filings show is this. The largest institutional investors in the world just decided that holding U.S. government bonds is no longer safe. Let me say that again. The safest asset class in the modern financial system, the foundation of global finance, the instrument every textbook tells you is risk-free, is being abandoned by the people who know the most. Now, you might be thinking, this sounds dramatic. This sounds like fear-mongering. This sounds like another doomsday prediction that won't come true. So let me show you exactly what happened, and let me show you why this is different. Let's start with who's selling. The California Public Employees Retirement System, CalPERS, the largest public pension fund in the United States, managing $350 billion. In the third quarter alone, they reduced their U.S. Treasury holdings by $42 billion. $42 billion. That's not a trim. That's not a tactical shift. That's a liquidation. The Teacher Retirement System of Texas, $200 billion in assets. They cut Treasury exposure by 31% in 6 months. Japan's Government Pension Investment Fund, the largest pension fund in the world, $1.7 trillion in total assets. They've been quietly selling U.S. bonds for 18 consecutive months. Not 1 month, not a few months, 18 months of continuous selling. Norway's Sovereign Wealth Fund, $1.6 trillion, the largest sovereign fund on earth. They reduced U.S. government bond holdings by 23% year over year. These are not retail investors panicking. These are not hedge funds making short-term bets. These are the most sophisticated, long-term, risk-averse institutions in the world, and they're running. But here's where it gets worse. They're not just selling, they're selling at a loss. Let me explain why that matters. When you buy a bond, you lock in an interest rate. If rates go up after you buy, the value of your bond goes down. That's basic bond math. Most of these institutions bought bonds in 2020 and 2021 when rates were near zero. Now rates are at 5%, which means those bonds are worth 30, 40, sometimes 50% less than what they paid. If they hold to maturity, they get their money back. But if they sell now, they take a massive loss. And they're selling anyway. Why? Because they see something worse coming. Something that makes a 30% loss today look like the smart move. Let's talk about what they might be seeing. The United States national debt is $36.2 trillion. It's growing by $2 trillion per year, every year, without fail. Interest payments on that debt just crossed $1 trillion annually. $1 trillion. Not going to schools, not going to roads, not going to defense, just interest, just the cost of servicing previous borrowing. And here's the trap. That $1 trillion has to be paid. But the government doesn't have $1 trillion in surplus, so they borrow more to pay the interest, which increases the debt, which increases next year's interest payment, which requires more borrowing. This is called a debt spiral. And the only way out is to either cut spending drastically, which is politically impossible, or raise taxes, which destroys growth, or print money, which causes inflation or default. Those are the options. And none of them are good for bondholders. Now, the traditional response to this argument is the United States will never default. The dollar is the reserve currency. The Fed can always print money, and technically that's true. But here's what people miss. Printing money to avoid default is a default. It's just a slower, quieter version. Instead of telling bondholders, we're not paying you, they pay you with dollars that are worth less. The number on your account statement stays the same, but what that number can buy shrinks. Your bond says $100,000. You get $100,000 back. But those dollars only buy what $50,000 used to. That's inflation. That's currency debasement. And that's exactly what these institutions are trying to avoid. Let me show you the historical pattern. Because this has happened before. Britain in the 1930s. The pound was the global reserve currency. British government debt reached 180% of GDP after World War I. Sound familiar? The United States is at 124% right now. Britain tried to manage the debt with low rates and controlled inflation. It didn't work. By 1931, they were forced to abandon the gold standard. The pound crashed. Bondholders lost 40% in real terms. And within 15 years, the dollar replaced the pound as the world's reserve currency. The empire that ruled for 2 centuries lost everything in a decade. Or look at Japan. 1990, Japan's debt was 60% of GDP. Manageable. Under control. They said they'd grow their way out. They said technology and exports would save them. 35 years later, Japan's debt is 264% of GDP. They never escaped. The debt just grew and grew and grew. And now they're trapped. Interest rates can't rise because the debt is too large. But keeping rates low means inflation erodes savings. It's a trap with no exit. The United States is following the exact same path. Debt rising faster than GDP, interest costs spiraling. Now the largest institutions in the world are saying, we've seen this before. We know how it ends, and we're getting out. But let's go deeper, because the 4.7 trillion withdrawal isn't just about US debt. It's about something more fundamental. It's about trust. Trust that the system will function. Trust that dollars will hold value. Trust that bonds will be repaid. And that trust is cracking. Here's what most people don't understand about the financial system. It runs on confidence, not gold, not assets, not collateral. Confidence, the belief that when you lend money, you'll get paid back. The belief that when you save dollars, they'll be worth something tomorrow. The belief that the rules won't change overnight. When that belief breaks, everything breaks. And we're starting to see the cracks. Foreign central banks are selling US treasuries. China reduced holdings from over 1 trillion in 2013 to 760 billion today. Japan, the largest foreign holder, cut by 63 billion last year alone. Saudi Arabia, which has recycled petrodollars into US bonds since the 1970s, is diversifying. They're accepting yuan for oil now. Yuan, Chinese currency, that was unthinkable 5 years ago. The petrodollar system, the foundation of dollar dominance, is fracturing in real time. And it's not just foreign governments. Domestic banks are selling too. JP Morgan reduced available for sale securities by 15%. Bank of America sold 37 billion. Citigroup cut 23 billion. Wells Fargo, Morgan Stanley, all of them selling. When you add it up, the total exceeds 800 billion in the past 18 months from the largest banks alone. Why? Why would banks sell bonds that are supposed to be safe? Because they're not safe anymore. Because the math doesn't work. Because holding bonds in a debt spiral is financial suicide. Let me show you what happens next. And this is where it gets truly dangerous. Right now, the selling is quiet. It's happening in footnotes, in regulatory filings, in disclosures released on Friday afternoons. The general public doesn't know. Retail investors don't know. Most financial advisors don't even know. But that won't last. At some point, the selling becomes visible. Bond prices start falling. Yields start spiking. And when yields spike, the media notices. Headlines appear. Treasury market in turmoil. Bond crash raises recession fears. And that's when the real panic starts. Because once the public knows, everyone tries to exit at once. Pension funds that were waiting, insurance companies that were hesitating, foreign governments that were holding on, all of them hit the sell button simultaneously. And when that happens, the cascade begins. Bond prices freefall, yields explode. The government tries to borrow at higher and higher rates. But higher rates make the debt even more expensive, which makes the deficit worse, which requires more borrowing, which pushes yields even higher. It's a feedback loop, a death spiral. And there's no way to stop it once it starts. Now, the Federal Reserve will try to intervene. They'll announce emergency bond purchases, quantitative easing, liquidity injections, all the same tools they used in 2008 and in 2020. But here's the problem. Every time they print money to buy bonds, inflation rises. And rising inflation makes people demand even higher yields. Because bondholders want to be compensated for losing purchasing power. So the Fed is trapped. Print money and inflation destroys the currency. Don't print money and the government can't fund itself. There's no good option. Both paths lead to disaster. And here's what makes this moment different from 2008. In 2008, the problem was private debt, mortgages, banks, Lehman Brothers. The government could step in and bail everyone out because government debt was still manageable. 10 trillion, 70% of GDP, high but not catastrophic. Today, government debt is 36 trillion, 124% of GDP. The government can't bail out the system because the government is the problem. The Federal Reserve can't save the bond market because the Federal Reserve's actions are what's destroying confidence. This is what the 4.7 trillion withdrawal is telling us. The insiders see it. The smartest money in the world sees it. And they're positioning for collapse, not might collapse. Not could collapse, will collapse. Now, let me address the counter-argument. Because I know what you're thinking. People have been predicting dollar collapse for decades. It hasn't happened. The system has survived every crisis. 2008, COVID, the debt ceiling fights. Every time the Fed steps in and everything goes back to normal. Why is this time different? Here's why. Every crisis makes the system more fragile. Every bailout requires more debt. Every round of money printing reduces confidence. You can patch a dam for years, decades even, but every patch weakens the structure. And eventually, one more crack is too many. In 2008, the Fed's balance sheet was $800 billion. They expanded it to $4 trillion to stop the crisis. In 2020, they expanded it to $9 trillion. That's 11 times larger than 2008. What happens in the next crisis? Do they go to 20 trillion? 30 trillion? At some point, printing money stops working. At some point, people stop accepting dollars. At some point, the currency itself becomes the crisis. And that's what the 4.7 trillion withdrawal is signaling. The insiders believe we're at that point. They believe the next crisis will be the one the Fed can't stop. They believe the dollar's reserve status is ending, and they're moving their money accordingly. So what does this mean for you? Let me be very direct. If you hold bonds, especially long-term bonds, you're exposed. If you have retirement savings and bond funds, you're exposed. If you're holding cash, thinking it's safe, you're exposed. Because when this breaks, it breaks fast. Silicon Valley Bank went from solvent to failed in 48 hours. Lehman Brothers collapsed over a weekend. The British pound lost 14% in a single day in 1967. When confidence cracks, there's no time to react. The exits jam, the prices gap down. And by the time you realize what's happening, it's already over. The 4.7 trillion withdrawal is the warning. It's the insiders moving before the crowd. It's the smart money exiting before panic sets in. It's the signal that says, if you're still holding bonds, you're on the wrong side of history. Now, I want to be very clear. I'm not telling you to panic. I'm not telling you to sell everything tomorrow. I'm not giving financial advice. What I'm telling you is this. The largest institutional investors in the world just made the biggest move in financial history. And they did it quietly, without headlines, without warnings. That move is now complete. The question is whether you'll see it in time, or whether you'll ask, like millions before you, how did I miss all the signs? The withdrawal already happened, 4.7 trillion. The insiders are out, the trap is set, and the clock is ticking.